it going, everyone? Mario here. In this video we're going to talk about what to expect from SPY and QQQ leading into this short week. This is a Thanksgiving week and the volume is going to be dry, and we're leading into seasonally one of the most bullish weeks on the markets ever. But we can't just take trades blindly based upon the seasonalities and expect the price to push up. We got to focus on the price action and see what to expect both in the bull case and in the bear case. So without further ado, let's get started. Looking into the daily charts of SPY, last week was just flat. Last week's price action reminds me of the similar price action which we had on SPY from May 28th all the way to June 8th. We had 2 weeks of just straight back and forth, and then finally the price broke to the downside. So now we're having the same consolidation and the price is still under the declining 200-day moving average, which is slowly sloping under 405, 404, and the more we consolidate, the more the 200 SMA is going to come all the way to the area of 400 where the price is trading at the moment. So if the bulls manage to break this range of 400 to 390 and start pushing higher, then the shorts are gonna cover, the market is gonna go all the way up to fill that gap at 408 and change. Now, if the consolidation range broke to the downside and the SPY starts closing candles under 390, well, the SPY is going to go all the way down to 385 or 382 or even 380 to the downside. So if we do break under, the area of 379.50 to 380 is important because that is the anchored VWAP from the CPI lows. So if we do break under the consolidation range, watch out for 385 and 380 to be tested to the downside. And if we do break above the consolidation range, watch out for that gap to fill at 408 and change to the upside. So now to the important thing. There are multiple ways to trade this choppy markets. If you are a day trader or if you're just scalping calls and puts, you can just go long or buy calls at the bottom of this consolidation range which we are having, which is currently at around 394, and sell it at around 398 or 400. You can just buy puts or go short on the markets at around 398 to 400 and then cover them at around 394. So this is just a back and forth trades you can take until one side gives up. So this is scenario one. So there is other class of traders. Let's say you're bullish markets. You have this thesis where like you are bullish onto the markets and you believe that the market is gonna break above 400 and break 402 and then go all the way to fill that gap to 408. If you come under that class of traders, what traders usually do is they scale up on their long positions every time SPY comes down to run a test to 394 and change. So every time SPY goes all the way down to 394, they add on to their long positions and then like expecting for that bounce to last, and then that's the bounce which is going to take SPY all the way above 400. So the longer it consolidates, the longer they keep adding a 394, and then they secure profits at around 408 after that gap fill. So this is for the bullish scenario. If you're bearish markets, this is another scenario. Whenever the SPY tests around 398 to 400, the traders open a new short position. And when it comes all the way back down to 394, their expectations are it's going to break 394, go all the way to 390, and it's going to break 390, and it's going to go all the way to 385. So now, this is the bull expectations, these are the bear expectations, and then the third class is just day trading or scalping. First, as a trader, you got to understand which class you come under. Looking at the price action, it's just consolidating. It can either break out or break down. No one knows. If you're a class of trader who is bullish, you can just keep adding to the long position at 394 and change. And if you're a trader who thinks the market is going to break down, you can just keep adding to your short positions at 400. One side is going to be right. This is where things get even more interesting. Let's assume you were long markets and you will keep adding on to your long positions at 394 every time SPY tests those levels. At Monday morning, market gaps down and opens under 394, or let's say the worst case scenario, 390. What do you think it's going to happen? Every single buyer at 394, it's going to get stopped out. Selling begets selling, the stop losses are going to kick in. It's going to cause a cascade of big meltdown to the downside. So this is the risk of holding on to long positions or adding on to the long positions at 394, expecting for the markets to push up. Same with the opposite. If you're short the markets and you've been shorting every time since the SPY tests like 398 to 400 every single time, and let's say the Monday the market opens above 402, every single short out there is going to cover buying begets buying. It's going to create the short squeeze which pushes the market all the way to 408 to fill that gap. But right here, at least your risk is defined. If you start closing candles under 394, you can get stopped out if they're longs. If you start closing candles above 402, you can get stopped out on your shorts. Or if you're just day trading, you can just like trade the bounce up and down depending on your time frame. There is another option when it comes to trading choppy markets, is that you don't actually trade it. You wait for the markets to pick the direction, either to the upside or to the downside, and once the direction is picked, then you add on to your positions, either to the short positions or to the long positions. So right now the market is just consolidating. It might as well consolidate into the short weekend as well, and it might as well consolidate for the next 1 or 2 months as well. We'll never know. For now, don't predict, just trade the charts which is offered in front of you. The charts are saying consolidation until proven otherwise. It's a similar case with QQQ, same consolidation from 294 all the way to 284 to the downside, same principles. So consolidation until proven otherwise over here as well. Now we have a clear-cut plan. If you're bullish, you know what to do. Keep adding at 394 with stop losses at closing candles under 390. And if you're bearish, start adding bearish positions or keep adding on to it as long as the price stays under 402. So here the risk is defined. If they start closing candles above 402, we get stopped out on our short positions. If they start closing candles under 390, we'll get stopped out of our long positions. So if you're a day trader, you can just start trading the range up and down until the range lasts. At the end of the day, we're not predicting anything, we're just getting prepared for regardless of what scenario plays out in the future. So that being said, take high probability trades, manage the risk wisely, check out the Discord, check out the Patreon, link is down below in the description. See you guys in the next one.